Right, hello everybody. It's Monday the 24th of April 2023. My name is Adrian Boothby. I'm the head of trading here at Trendsignal, and this is today's podcast, the US debt default risks rise. Now, to talk about this and setting us up for the week, as ever, is Jerry Miller, the managing director here at Trendsignal. Hi, Jerry.
Morning, Adrian. Morning, all.
Good. So why don't you take us a bit about that? Because there's quite a bit to go through, isn't there, this week?
Yeah, sort of. I mean, last week wasn't brilliantly interesting. It was a little bit of a sort of a subdued week, but there's a lot to look forward to in terms of rate decisions in the next, well, not this week, but next week. But we got to gauge every week as we lead up to it, and there are quite a few topics to discuss.
So, what would the top topics be, Jerry?
I would say, first of all, really what's going on in the US with interest rate expectations. So the Federal Reserve, that's the US central bank, are meeting next week to deliberate on interest rates, and everything that is discussed really in the financial press is all to do with what the Federal Reserve are going to do. Are they going to raise rates by a quarter? Are they then going to keep on raising rates? Will they get as high as whatever? And will they then cut rates by the year end? And all I would say is to everyone, it's a very fluid situation. And at this time, we're expecting a quarter point hike in interest rates next week. And the irony with everything that's going on is that we're actually likely to have a technical recession in the US. And as we've discussed in previous podcasts, this means 2 quarters. So that's 2 3-month periods. So a quarter is, say, January, February, March. But in this case, it's more likely to be July, August, September, and then October, November, December. 2 quarters of negative growth. So where growth is, like a -0.1 or -0.2. So we think that's going to happen in the US. At the same time, interest rate expectations have actually firmed up just a little bit. I could say a wee bit, having been up in Scotland. It's likely that rates will go up to 5% and then be cut probably sometime in September to November meeting. There isn't a meeting in October. If you want to if you can just share your screen on the FedWatch tool, Adrian, that's we can then have a look at that. But it certainly changed since the height of the mini banking crisis, where there were going to be no further rate hikes, and there were going to be at least a half-point cut in rates by November. So that's all changed. And in fact, the CEO of, I think it was Blackstone, came out and said that he doesn't expect any cuts in rates by the end of the year. So there's some quite serious players out there that letting their views be known.
Well, it's an interesting one, isn't it? Because there's certainly, as you say, it is a very fluid thing. There's been a lot of changes in interest rate perceptions. And you might think, well, why are we talking about this for a trading podcast? This is not an economics podcast, but it has such an impact on the indices, so the stock market, and also currencies as well, particularly if it's dollar related interest rates, it's going to have impact on the dollar. So definitely keeps the market more interesting, that's for sure, and gets more, when you have that fluid process, you get a lot more turning points, a lot more boost, breakouts on the market, makes it much more interesting for traders. So it's all good for us, I think, really. So Joe, what about there's a few concerns about the US debt default as well. Do you want to take us through a bit about that?
Yeah, that's sort of been brewing up, and I've been watching it over the last 2 or 3 weeks, and it's so unlikely that I decided it wasn't worth discussing. But actually, there is growing concern about the possibility of a US debt default. And what we mean by a debt default, it's basically where the US government doesn't meet its obligations to its bondholders, i.e. doesn't repay bonds, doesn't pay the interest due on those bonds. And you might think, hang on a second, this isn't a developing country. This is the United States. The reason being is that if the US wants to increase its debt or its debt ceiling, it has to get permission from Congress. And this requires Democrats and Republicans to meet and engage in what's referred to as non-partisan, I should say, constructive talks to avert a government shutdown. And I think a lot of analysts are looking at what's going on and saying there's none of that happening at the moment. Not only that, but tax receipts are weaker than normal at this time of year. What I mean by tax receipts, that's companies paying big corporation tax bills and individuals paying their tax bills, etc., etc. But that's bringing forward the date when, without any agreement for an increase in the debt ceiling, that the government will be forced to shut down departments in the US. And that is what's stressing the markets a little bit. And you could see that in something called credit default swaps. And you're probably all thinking, oh my God, hang on, credit default swaps, CDS, that's something to do with the Great Recession, isn't it? It is, but these are instruments that are used all the time, and they're designed to pay out when a company, or in this case, a government, defaults on its obligations to its bondholders. So 1 year credit default swap. So that's where if you buy a 1 year credit default, you've got protection for a year. So in the event that the US government defaults, you get a big payout. And that's costing about 106 basis points, or to put it another way, 1.06%, Adrian.
Okay.
Interesting, because that's up 15 basis points on the year, so 0.15% on the year. So they tend to be quite high in the US because of the risk that they don't agree on increasing the debt ceiling at any time. But it compares with the UK at 14 basis points, so 106 versus 14. So
Wow.
you can see that this cost of insuring debt, or the jump in the cost of insuring this against a US default, that's jumped largely in reaction to the shortening of the date when the US government runs out of money. Anyway, that's a big deal. I mean, it's a
reflection of the risk associated, isn't it? So it basically means it's not say it's likely to happen, but it's a bigger growing concern. And we've had things before. We talk about the economic calendar every week, don't we? And I remember this is probably about 4 years ago now, where non-farm payroll, the job release data was delayed by. It was the fiscal standoff, wasn't it? I think at the time they called it, and they couldn't actually release non-farm payroll data because they couldn't pay the employees to compile the data in the first place. And you think, what, the US? That's just ridiculous.
Yeah.
But I guess what they're having to do is increase their borrowing. This is the problem. They have to increase their borrowing in order to pay out the interest on the bonds, isn't it? And that's
that's right.
Disastrous situation to be in, quite frankly.
Effectively, the Treasury runs out of money if it can't sell new bonds, i.e. raise more capital in the capital markets to pay for its expenditure. And there's a very interesting website called US Debt Clock. I mean, I wouldn't suggest you look at it now, but it's frightening when you look
I've
how
seen
much.
It. Yeah.
When with it's not just the US debt; it's everything to do with money and the US. It's just extraordinary. But it puts a real brake on government if the government is required to get permission from Congress, from the elected representatives, to allow the government to raise the debt and the debt ceiling. But it does cause these embarrassing moments where it looks like the US can't afford to pay its staff. And as you say, with non-farm payroll, that's released by the Bureau of Labor Statistics. Well, they're a government department. They won't work if they don't get paid and they get laid off. Yeah.
So what does this mean for us as traders? It just increases to the sort of the melting pot of volatility, doesn't it? Because that uncertainty just is going to create more and more movement for the markets, which is ultimately great for traders, isn't it?
Yeah, it is. I mean, we love good volatility. Bad volatility is where the markets go absolutely nuts, and that happens occasionally. But it's a bit like having a sailing dinghy. You want a decent amount of wind, but you don't want it blowing a gale, and you don't want no wind. So most of the time we get a good breeze. That's what we like. So this just adds to the flux in the market, which gives us opportunities, because markets inhale and exhale. They don't just go in a straight line, Adrian, as all us traders know. And it's those movements up and down that create the opportunities that we benefit from.
Yeah, no, that's great. Okay, thank you for that. So just quickly before we move on to sort of some of the movements we've had, PPI was one of the things we talked about last week's podcast about, one of the items of data to be aware of. Just take us through just quickly about that. That was on Friday last week.
Friday last week, was it? I'm trying to think. Are you referring to the UK PPI?
Sorry, PMI I'm talking about. Yes, yeah, the UK PPI. So I'm getting a
PPI.
bit.
No, it's fine. It's fine. So the PPI, the Producer Price Index. See,
Yeah,
that's interesting. So last week, if you want to look at the calendar from last week, do you remember
yeah,
we got inflation out, UK inflation, and that was all a bit disappointing. Like the previous month's number at 10.4 was a jump. That was not what was expected. The 10.1%, yeah, it's better than 10.4, but it was expected at 9.8. And you sort of think, well, why did the FTSE not sell off as much, and why has sterling remained as steady as it is, and why are the UK markets doing okay? And I think there's some interesting, if you look underneath the surface, and one bit of data that they did not, you won't see in the, so this is released by the ONS, the Office for National Statistics in the UK, and in the report, and I downloaded the report, is the PPI, the Producer Price Index, which is, that measures the costs going into production. I mean, it used to be called factory gate prices, but obviously a lot of the businesses here in the UK are services based, so you don't have a factory gate at a service, but they do have their own input costs. And just to let you know, the year to March PPI rose 8.7%. Now you're probably thinking, okay, so the cost, that's quite high, isn't it, Jerry? And I would say, yeah, it's less than inflation is at the moment, but its PPI was 11.9% in the year to February, and it's now 8.7 in the year to March. What does that tell us? It tells us that costs going into production are falling sharply, and this bodes well for falls in future inflation. And that's the point. And I think that's the reason why the market remained quite steady last week.
that's
That's
brilliant.
sterling
Thank you.
market for me, yeah.
No, that's great. Thank you, Jerry, for that. Let's have a quick look. I think you wanted to talk a bit about gold, didn't you? Do you want to just
Yeah, just
do
very,
that?
very quickly, because I know you've got some time constraints here, but gold sort of continues to float with that $2,000 level. And whilst I've referred to central bank purchases over the last few months, it actually has got quite intense now. And there's an interesting article in the FT by this chap, Rashir Sharma, who's a sort of guest contributor. And he pointed out that central bank buyers are actually in the developing world: China, Russia, India. And these three central banks have had discussions with Brazil and South Africa. It's like the congregation of the, yeah, it's like the ones that aren't in the developed world's favor. And what they're looking to do is to create a new currency. And you think, really? But one of the reasons that they want to is because the US always or continues to use economic sanctions on countries that step out of line, like the likes of Russia, for example. And these sanctions do hurt. And if they have a new currency, a way of basically getting round these sanctions, they would be in a better state. Will it happen? No, not for a long time. I mean, the percentage of world trade that's conducted in dollars is like 80%. So the likelihood that Russia, China, and South Africa and India will be able to do that is pretty remote. But it's just interesting to read. Obviously, there are other drivers for gold as well. Obviously, with the dollar falling, that the weakening dollar will help all dollar denominated commodities. So it's not just that side of it, but it's interesting that it's literally 9 out of 10 central banks are in the developing world, not in the developed world, and they're doing it in a deliberate way because they want to foster discussions about an alternative to the US dollar as the sort of international trading currency.
Interesting. All right, great. Thank you, Jerry.
Yeah.
So that's what we know. What about what we don't know yet? We've got a few bits coming out this week. It's not one of the biggest weeks in the world for economic data, but if we could say perhaps the top two items for economic announcements this week. Obviously, we've got Q1 earnings. We're sort of in the thick of it now, aren't we, in the US with their
Yeah, we've got big tech. We've had the banks out in the US. When we talk about quarterly earnings, there are quarterly earnings in Europe and the UK. But when that's the big focus is in the US, because they really do drive obviously US markets, but also our markets. And we've got what is referred to as big tech, the FANGs. So this week, I think we've got Amazon, Alphabet, Meta that owns Facebook, and Microsoft. So that'll keep the markets occupied this week. And we've got banks here in the UK. I think we've had HSBC, and I think Barclays, NatWest, and Standard Chartered are coming out this week. So that's them. In terms of ones I'd pick on in terms of releases, I'd say the flash GDP data coming out in the US and in Europe. So first of all, Thursday for the, it's called, okay, in the US they call it advanced. They've got 3 readings, and one of them, the first one, is called the advanced reading. Rather confusingly, they then follow that up with the preliminary reading, which I don't know about you, is just a little bit the wrong way around. Anyway, the GDP data is, it's slowing, put it that way. But it's you need to look at the advanced GDP. You clicked on the price index. It's the 2 above it. Advanced GDP. Yeah. No, it's okay. It's okay. That's also important, by the way, the price index, because that tells us the effect of the price increase, effectively inflation that's pushing up GDP. But 2%. So you can see the whole the economy is slowing in the US, and apropos my reference to a mild recession, eventually GDP will go below 0 as these interest rate hikes take effect. It is a backward-looking set of data, like the one I'm going to tell you about for the Eurozone as well. It really tells us what has happened, and it gives us a little idea about any future economic activity, really, Adrian. But it's worth noting, things are slowing in the US, and then if you scroll down to the EU data, it should be flash. Yes.
Do I need the? Let's have a quick.
Yeah, you do. Unfortunately, you do. For some reason, Forex Factory, in their infinite wisdom, have put it as a low impact bit of data. But so if you look, you can see flash 10 a.m. flash just above ECOFIN meetings. Do you see that?
Yeah,
you got it. Yeah. So this, like the US, it's the flash GDP plus 0.2% following the previous quarter's revised, flat reading, really. Growth has been struggling, Adrian. You've got Germany have really been mired in a very tough period with the jump in energy prices, especially gas. They were 40% dependent on Russian gas, and not as bad as Italy, but they really did struggle. And then you had obviously the slowdown in China, which is one of their big markets, with the zero COVID policy. And I think it just depends how much China's improving and whether that's played its part. But there's a risk that the GDP could be a little bit higher than that.
Okay. Jerry, that's great. Thank you. We'll leave it there. Thanks very much for being with us today. So what I'm going to do now is just take a look at some of the markets and some of the things that are of interest to us at the moment. There's been some really nice moves on the markets actually over the last few weeks. April for the D1 Sniper strategy here at Trendsignal, we're up 9.4% right now. That's from risking 2% of your account on each trade. So really strong move there. The D1 Accelerator up about 19%. So really strong growth there also. What I've been doing in these sessions, just have a look at some of the more popular markets and having a look at where we're at with those. So euro dollar as an example. Previously, we kind of hit a recent resistance level. We hit that number about a week ago, just over a week ago there. So we nudged that. We're now looking to the sort of the next level, if we can go from there, which will be up to around 111.24. So we're very much keeping our pencil sharpened at this stage. Up to that level. That's from here. That's the price from which we fell quite dramatically just over a year ago. So we're heading back towards those levels. So don't be surprised if we see the market rally a little bit. 111.24 on euro dollar. Potential buying opportunity. Oh God, what am I doing with my mouse? That's all going all kinds of crazy. Potential buying opportunity setting up for our members tonight on the charts. We'll be looking very closely at this opportunity into the close tonight. Pound against the US dollar. Similar as you kind of might expect there, really. Not so clever on the 13th of April, but that's okay. Still got strong uptrends. We've got the weekly up, the monthly chart is positive. We're still putting in sort of a couple of higher lows there. So there's some interesting stuff that is on the charts. Suggesting again a continuance to higher prices. Next price objective will be 126.35. So 126.35, which is based on the resistance level back last time we were up at this point, which is in June last year. So keep an eye out for that. Also, S&Ps, I find probably one of the most interesting markets at the moment. It's really stuck in a very narrow range for the last week or so. We banged in, and we talked about this quite a bit, 4160, the key price from which we fell back in February. Number of times price has really struggled to break through that 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 times, but the day has gone above 4160 and closed below it. So it's an important level, I think. If we can take out 4160 and close above 4160 on the S&P 500, then don't be surprised if we see a little bit of a breakout from there. Free air up to 4301. Okay, so be aware very much of that. So 4160, need to see a close on the S&P cash above that level to see a continuance, down to around 4080 for a level of support there. Finally, having a look at gold. This market here had a nice short trade from a few days ago, really nice profit on that one. But again, 1936, these two pivot points here for a bit of support for gold, and then up to 2052 as the next level of resistance from there. Again, going back to, don't worry about the annotations I've got on here, that high back from July 2020. We're moving back towards that sort of level. If we can see us nudging, we nudged it back in March last year. Will we have another look up to 2052? We'll see, won't we? But certainly that's the key price from which we fell quite dramatically in July 2020. So keep an eye out for a little bit of resistance there if we see the market start to turn back higher. In terms of some of the recent trades, let's have a quick look at those. New Zealand dollar against the US dollar. Been some decent moves on this market. Loss-making trade there. That's okay. Nice short trade though from the 17th of April. That was a profit of about 2%, just shy of 2% on that particular opportunity. So that's really nice. The oils are moving on really nicely as well. So really nice rotations actually on oil for the last probably 5 to 6 months. We can see the short trade there from the 16th. Has gone very, very well indeed. That was a profit around, I think the UK and US oil collectively were up about 5%. So really good trading opportunities for us on both of those. You can see quite a say substantial, big size candlesticks falling mid last week. So some good profits there. Otherwise, a couple of little bits, just one more market to have a look at. We'll highlight there being euro against the Australian dollar. That triggered as a buy on Friday. You know, one of the things that we often get asked is, what are the good times to trade? Well, Friday is as good as any other day, really. You know, sometimes people think, well, you know, is Friday a good time to trade? You've got the weekend coming up. Are the results as good on a Friday as other days? They're pretty much middle of the road. You know, they're not the best day of the week. They're not the worst day of the week, which means that actually we can continue to trade them all right, really. So Friday, the 21st of April, there was the buy. Here we are now about 60 odd points higher, and that was about a 1% winner there on the euro against the Australian dollar. So some decent moves there. Like I said, April, D1 Sniper up about 9%, D1 Accelerator up around 19% there. So some really good stuff. So that's what we should be trading. Sort of a bit out of sync on the slides there. And then finally, what's the problem? So this little feature, what I like to do is just take a small problem or maybe even a large problem and try and get through it in 2 or 3 minutes, try and give a bit of guidance on how we can overcome it. For me, right now, we're talking about time frames. The choice of time frame, this is the chart interval that you might look at. So you might look at a 1-minute chart, 5-minute chart, hourly chart, daily chart, or anything really. What does it effectively mean? Really, I look at it as though it's a frequency in which you're making your decisions. So if you're looking at a daily chart where each candlestick represents one day, what it basically means is you're looking to make a decision daily. So you're going to have a look on the charts. with a view to making a decision that day. Now, you're not going to get a trade every day on each market, but you might get a trade a couple of times a month on each market. But of course, when you're trading on the daily chart, you might trade more markets and so on. We look at over 30 markets, forex indices and commodities. But the daily chart basically means if you're quite a busy person, let's say you've got a job or maybe you're retired, but you want to keep busy and keep away from the screen to a certain degree, then you're looking at the markets once a day with a view to identifying new trades. Now, that could be a time commitment of an hour to 20 minutes, depending on the type of strategy you're looking at. The point basically is you select the time frame according to the lifestyle you lead. So once a day would be the daily chart. Once per week, because you're super busy or you just don't want to commit any time really to hardly at all, would be, say, the weekly chart. Now, when you start allocating more time with trading, you might start to say, well, actually, I'm liking this, I'm enjoying it, I want to spend more time doing it. You can maybe start to spend a few more hours at it. So looking at the markets every 3 or 4 hours would suggest the 4-hour chart would be the best time frame for you. And this is key here, that you are on the time frame that best suits your desire and best suits your ability and time to look at the markets. Okay, the more you don't do that, the more you're likely to contradict your strategy because or trade against it, because you're never going to be there when the strategy is identifying an opportunity for you. So if you've got a good strategy, at least have the opportunity to follow it properly, or give yourself the opportunity to follow it properly. And then as you go down to amount of time, so 4-hour chart, like I said, 2 or 3 times a day, 20 minutes, that sort of thing. If you're trading off a 15-minute chart, you need a lot of time, because effectively what you're doing is making a decision every 15 minutes. Now, typically you're going to be in a trade for probably 5 or 6 bars. That's a couple of hours, an hour and a half, couple of hours. And it's nothing to say you're going to get that trade set up straight away. So typically trading on a 15-minute chart, you probably need something like 6 or 7 or 8 hours a day to be trading actively. That's quite a big commitment. If you don't want to spend that time, ironically, you'd go even further down the time frame. Because the way it works, something like a 2-minute chart, effectively in a 2-minute chart, there are 30 candlesticks in an hour. That basically means over 2 hours, there are 60 candlesticks. There's a lot of price movement, a lot of opportunities that could happen over that period. So if you go on the basis that you'll get a trade every 20 candlesticks with the Trendsignal strategies, that gives you a broad idea that you'll get 2 or 3 or 4 trades trading the 2-minute charts over a 2-hour block of time. So why is this important? If you've got a couple of hours to trade, I'd recommend something like a 2-minute chart. If you've got 7 or 8 hours a day to trade, which very few have, something like a 5 or a 15-minute chart might be better. And if you've got less time than that, a little bite-sized pocket of 20 minutes, once, twice, 3, 4 to 5 times a day, then it'll be the daily chart or the 4-hour chart that's best for you. The more you slot trading alongside that day-to-day lifestyle, the better your trading is likely to be. And that's basically it. So that's the problem. Hopefully we've nailed that down. I would encourage you to have a think about your day-to-day commitments. When can you slot trading in? And then select the time frame based on the frequency of decision points that best suits your day-to-day lifestyle. Otherwise, everybody, we shall not be back next week because we've got a bank holiday next Monday. So I think it'll be a couple of weeks before we're back for the podcast. But in the meantime, have a great week or two's trading. Hope you make lots of profits, and we'll catch up next time. Bye-bye for now.